Hi, I'm Dolph Janis at Clear Income Strategies Group. I want to personally welcome you to today's webinar on Biden's Tax Plan 2.0 and how it could affect you in going forward in your retirement. A couple months ago, we did a webinar on the Biden Tax Plan 1.0, and now he's been in office for over 100 days. Things are changing. Stipulations are happening. New changes are coming along the line, and he's announcing this, that, and the other. And we just want to share that with you going forward. So again, thank you for joining us. On the screen on the right, you will notice there are some handouts about the tax plan presentation, Medicare, and all the tax job cuts is also there. There's also a section over there on the right side for answering questions. You can type your question in. I'll be more happy to get to you. I'll probably get to it at the end of the webinar, as I might answer the question during the webinar, or other people for times purposes, be able to answer those one-on-one for you. So again, thank you for enjoying this next 33 to 34 minutes, and I hope you enjoy the information we get for you. I mean, people look at how it began. I've had a storied career. I mean, went from the great state of Michigan. I was in law enforcement, and then luck behold me, I ended up in Nevada, and moved to a little town called Reno, Nevada. Absolutely gorgeous. I worked there and in Lake Tahoe, and I always liked educating people. And when I became a dealer, a casino dealer, mind you, learning and educating them how to all the different bets on craps would be and so forth. And it was so much fun learning. And I was teaching and teaching and teaching. And when I started dealing on the tables and stuff, and then eventually in Vegas and back up to Lake Tahoe, teaching people the game was, but it was like teaching somebody how to lose it was the hurtful thing. And I want people to win. I like people to go forward in life, not go backwards. And I see a lot of guys come in and became friends with some of them because a lot of them were locals, and they'd be betting, and they'd be losing, they're losing. I'm like, God, I just don't like seeing people lose money. I mean, it's a game of chance. It's like the stock market. It's a game of chance and winning and losing. And so that was one of the turnarounds when I came and got into this industry, was because I was sick of seeing people going backwards. I like people going forward. I like people educating them on how to do the best. And that's a little story about my history of how I became for the last 18 years to be doing what I'm doing, because I always tell myself I'm an educator first and advisor second. I've been fortunate enough to, and I'm still doing this. I mean, I've been on Forbes 3 times. These are a lot of the publications. There's more, but we couldn't fit them on the screen. We have all these articles that I've written and have been part of on our website. If there's any of them you'd like to see, just please let us know. About a year or two ago, I wrote a book called Cross the Bridge Retirement. It's complimentary. We can give you a PDF portion of it or a live version. Just respond to us. We'd be more than happy to get you this book. I wrote this book from the bottom of my heart on firm experiences that I've seen over the last 18 years on getting to and staying in retirement. And it's a beautiful thing to go through. So now let's get into the meat and potatoes of this, the agenda. We're going to go through 3 different portions of this presentation, finishing with the Biden new tax plan 2.0 and how it's progressed over the last 100 plus days and the last couple of years of what we've been used to. The first section we're going to go into is the 2021 tax overview. Then we're going to go into the Trump tax plan changes that he made, and then going into the Biden 2.0 tax plan. So let's start with the general 2021. That's a tough word for me to say that 2 times fast. And if I'm talking a little fast, I'm going to slow it down a little bit now that the presentation's starting for you. So if you're thinking, I've already got 3 people say, Dolph, slow down. I said, well, beginning of all my presentations, I like to talk a little fast, and then because I'm so passionate about what I do. And so, yes, John, Peter, and Sally, well, Joan, I just saw before, said, slow down, Dolph. So here we go. Federal income taxes are assumptions that they're always not going to be true for retirement. These are things that people think in retirement that are going to be, I mean, I'll be in a lower tax bracket in retirement. My lifestyle costs will be lower. I'll just follow the 4% rule of thumb for my retirement. These are all myths when it comes into retirement. Because remember, when you retire, and I said, I'm more happy to share my Forbes article, The Hardest Day of Your Life is the Day You Retire, which had over 3 million hits on that, was the highest one. It was ridiculous. It was so heartwarming to see that many people wanting to read that article. But every day is Saturday. I mean, you're paying yourself when you go into retirement, and taxes is always going to be up there. Death and taxes, they say, are always going side by side. And you're not necessarily going to be in a lower tax bracket, because remember, Social Security, if you're married and you get over $46,000, 85% of that Social Security paycheck is going to be taxed. It's going to count towards your taxes. Then if you're taking money out of your qualified accounts, your IRAs, that's going to be taxable. So there's a lot of those things about taxable, and they're going up. Your lifestyle costs are going to be lower. That's a myth. I mean, you're going to be spending more, believe it or not, in retirement. So you have to budget yourself properly. That's one of the things that we specialize here is budgeting your income properly. And the 4% rule, well, that's down. That was by Morningstar many years ago, and now that's actually down to 2.8% because guess what? People are living longer. Yes, medical technology is unbelievable, and people are living longer in retirement. I mean, the current federal tax code, is shifting. On the left side, you're going to be seeing the tax bracket. And I said, this isn't one of our handouts, so we're not going to go over all this slide by slide, but you're going to see the tax bracket, your single income, your married filing separately, your head of household. These are all what the current tax code of 2021 is. Now, another myth in retirement, we're going to pick on the married person filing jointly at 24%. They made $329,850. That's at 24%. Everything below 172 is at 22%. Anything above 329,850, that jumps into the 32% tax bracket. So just because you made, let's say, $330,000, your whole amount isn't at 32%. Just that 150 bucks is at 32%. Very important to know when you're doing your tax code. And we have a tax plan that we run. If you give us a call, it's complimentary. It takes 10 to 15 minutes to run your personal tax plan on current tax rates, even with the Joe Biden 2.0 in there. It will show you where your tax bracket falls and how much more money you can potentially take out in there. And then again, I just talked about it. How important is that $1 in taxes? And the largest tax bracket jump goes from 12% to 22%. So what happens if your income is at $81,051 and you move in the next tax bracket by just $1? $1. Not much. Here's another myth. The only $1 is for the new tax bracket, which is at 22%. So that $1 will cost you 22 cents. All the other ones will cost you 12 cents. Very important. And that's where the tax map software helps you budget in retirement to make sure you're getting the most out of your money. Now, one of the big things about the current tax code was the increase in standard deductions that was put in last year by President Trump. The standard deduction for 2021 is went up to $25,100 for married and $12,550 for single in 2021. So those are 65 or older, an additional $1,350 can be deducted for each spouse filing separately. And the goal was to reduce the number of people itemizing their deductions because everybody's like looking at, is it a write-off? Is it a write-off? Is it a write-off? And if you ever watch Seinfeld, remember Kramer, one of my favorite characters is when the VCR broke, it's, hey, Jerry, it's just a write-off. It's just a write-off. Everything's a write-off. Well, in the eyes of the government, that's not true. Certain things are deducted. And what the government was, President Trump and the past administration was trying to do was to quicken the tax code quicker to give you a higher deduction. So that first $25,100 that you had in your taxes went way, way up was tax-free. So you didn't have to pay taxes on that, hence eliminating all the deductions going forward. Also, many federal tax deductions may be longer than advantaged. Interest on mortgages, deduction-wise, retirement plan contributions, 401ks, IRAs, 403s, and SEP, dependent deductions, charity deductions. These are very important to understand what the deductions are on that in retirement because there's a thing called a QCD, which I talk about with every one of my clients, that a QCD is a qualified charitable distribution in retirement. If you're taking out money out of your IRA and you can transfer that to a church or a charity, that is a tax deduction and you're not paying on that. So let's just say you go to Church of the ABC and you give them $10,000 a year out of your pocket. Well, you get a little deduction out of that, but if you take it from your IRA and transfer that money directly to them, the QCD applies. And guess what? You don't have to pay taxes on that $10,000. Just a small little tip on how to save money in taxes. Now, if you look through the history, we're going back to 1913, and you can see this looks like one of the roller coasters at Carowinds, up, down, steady, steady, steady. These are the top marginal federal tax brackets, tax rates, all the way to 2018. They haven't really been updated for the last 2 years, but guess what? It's going up, it's going up, it's going up in the last part of the roller coaster. But this is pretty much a figure where you can see where the tax structure did. Imagine in the 50s, tax rates were at 90%. Holy moly, how did people survive? And we're complaining at 30, 35%. It's going up, inflation's going up. Properly doing your taxes is so important going forward. Again, interest rates on public debt historically, You can see where the 10-year treasury note is, the 3-year treasury note is, projections to go where they're at. I mean, you can look where we're at right now. Those are projections just to slowly increase. But look at early in the years from the 2000 after the 9/11 and the dot-com bust and stuff, how those things just went. Phew. Another thing to be paying attention to is on interest rates. When's the right time to refinance? When's the right time to get your taxes in order to pay less in taxes? Very important. Because taxes in retirement, many retirees and pre-retirees have some sort of tax deferred accounts, whether it's an annuity, whether it's an IRA, a 401k, those are tax deferred accounts. Accounts you're not paying taxes on until you take your money out. Those accounts are taxed for whatever federal income tax rate is when you start drawing money from them down the road. And there's two different types of taxes you could occur in retirement: ordinary income tax, which is generally the most, and social security tax, which I mentioned earlier. Depending on how much money you make in retirement, that social security money could be taxed, bam, right at you. Something you got to prepare for in retirement. The key takeaways of the 2021 current is the tax deductions that applied during your working years may be longer applied in retirement. The Tax Cut and Jobs Act of 2017 did make significant changes to the tax code that could affect your tax strategy in retirement. That's very important to know those. And in our tax map software that we do run, this can help you out for you. And I see questions popping in saying, thank you so much for, I mean, we're going to get to those. Trust me, we're going to get to the Biden things here and what's going to happen going forward. But future federal income tax rates are historically low, but they could increase in the future. You're seeing that right now. Lower interest rates could mean higher taxes in the future. Just because something's lower doesn't mean it can't go higher. It's another myth. And we're talking about a lot of myths going in retirement. Your tax deferred accounts are taxed at a regular income when distributed in retirement, not capital wise, ordinary income. It's very important. Like when you're taking money out of a tax deferred account, it counts as ordinary income. And it's very important to understand the Secure Act changes that impact retirees and to speak to someone about those. Hence, someone I was talking to the other day was 71 years old and he came in to take out his RMD and he was like, I'm like, what are you doing this for? And he's like, well, I have to take my RMD out. I was like, no, not until you're 72. And he's like, oh, really? When did that happen? These are things that some financial professionals weren't telling people. When I informed Mr. Johnson about this, he was like, he was excited. He's like, well, my guy over at certain place didn't tell me about this stuff. And I've been taking it out for the last 2 years. I said, oops, lost money. So this section's not that long, but this is basically about the Trump tax changes and what he implemented during his short term in office. Biggest gross tax cuts in American history, over 5.5 trillion over 10 years. Wonderful. Kept deductions for retirement savings. Allow retirees of 70 and a half or older to directly transfer up to $100,000 a year in qualified charities from their IRA. This transfer counts towards the taxpayer RMD for that tax year, but isn't included in the taxpayer's adjusted gross income. This was the QCD I was just talking about, something that they put in there. He just enhanced it from, I think it was like 15,000 all the way up to $100,000. Obviously, a lot of people out there don't have $100,000 spare money to give to charities to lower their income, but some of the wealthier people out there, this is called a transfer of wealth, a way to pass more money on to your heirs and pay less in taxes in the future. Because at the end of the day, folks, the most important thing we got here is how do we pay less in taxes legally? That's what's really important. Okay, the nuts and credits. Mind you, this is not me speaking, even though I'm talking. These are all things that have been coded, all things have been found about Biden's new tax plan 2.0 and what is different over the last 100 days or so. So this is not my personal opinion. And a couple things I'll throw my personal opinion in there for, but these are actual things that he's talking about. Joe Biden and taxes before the election, he proposed several tax changes to help senior citizens and those who care for him. He promised to increase tax benefits for elderly who pay for long-term care insurance with the retirement savings, and want to allow low-wage workers over 65 of age to claim earned income credit. Again, this is before the election. A lot of things are talked about in campaigning and stuff. So what happens after the election is there. Because is there a history of higher tax bracket after massive spending? Now, it's pretty safe to say right now we are in massive spending. I mean, how many trillions of dollars have been taken out ready for stimulus and for COVID relief and stuff that, where is it really going? Is it going to COVID relief or is it going to different places? I can't say, but you do know the answer to that. You decide. But let's look at the tax rates through history. I mean, this slide is available to everybody. If I went over this slide, we could spend another 45 minutes on this, but I don't want, and I'm sure nobody wants to do that, but look over this. Let's just jump right to 1990. The top tax rate jumped to 39.6%. World War II in 1944, the top rate packed at 94% on taxable income over 200,000. Now it's $2.5 million today, but in 2013 and 17, the Affordable Care Act tacked on an extra 3.8% on the tax top rate. Everybody wants to be successful. Everybody wants to make more money. Everybody wants to have more money. But I don't think you should be penalized for having more money because you're becoming successful better than all these people sitting at home not working by choice. You can work if you want to, folks. It's not that difficult. Now, Biden's first day is tax agenda, and this is what we covered in our previous one a couple of months ago. Under Biden's leadership, he plans to overhaul the income tax system, moving it towards a more progressive direction and putting more of the financial burden on the wealthy, playing higher tax rates on those who earned more money and made more money. As proposed in his campaign, he intends to increase corporate federal income tax from 21 to 28%. Not a fan of that because I am a business owner and I don't like to have to pay more taxes for not doing anything wrong. And individuals, he expect to decrease by about 3%. Again, 3%, if you think about it, that's every $100,000, it's $3,000 that you're losing. If you have $500,000, it's $15,000. Doesn't seem like 3% doesn't seem like a lot. $15,000 a year, or someone who's making $500,000, tack that over 10 years, that's $150,000 that your kids should have gotten. Now, this is a proposal of his President Biden's highlights. I mean, these are things that he wants to do. He wants to repeal the components for high income filers. He wants to impose a higher Social Security payroll tax for people above 400,000. He wants to increase the corporate tax rates to 28,000, establish a corporate minimum on tax book income. He wants to double the tax rates on JOTA and impose it country by country, temporarily increase the generosity of the Child Care Act and Dependent Act. I mean, what does this mean to you? It all has a similar fortune. Spending, spending, spending. Where's he going to get the money back from? Where's he going to get the money back from? Well, guess taxes, taxes, taxes. I mean, if you look at the conventional revenue, the dynamic revenue, the GDP is down 1.62%, which is huge. Capital stock is down 3.75. This is just in the beginning, 100 and some days. And full-time jobs is over 500,000 people are lost. These are things that we have to worry about. These are things that we have to prepare for. We can't control what happens in Washington. We can say what we want, but prepare for ourselves. So in a lot of persons, this is my personal opinion, some of this stuff could be good long-term. Some of this thing could be effective long-term. It's not for me to decide, but it's a case-by-case basis going forward. He's also repealing big parts of the Trump 2017 tax cuts. I mean, this is where federal tax rates are going to go back to 39.6 from 37. Again, it's only 3%, but take 3% over, hey, just take $1,000. It's $30 times 10 years. It's $3,600. I mean, it's a lot of money. It adds up. Raising the corporate tax rate by 7%. Now that's a big jump. Itemized deductions capped at 28% for 48 people making over 400K. That's huge. No tax rate increases for anyone in less than $400,000. So, Mr. Jones, I'm going to ask you. I'm going to give you a job. I'm going to pay you $410,000 a year. And you're like, no. Pay me $390, please. Well, no, I'm going to pay you $410. No, $390 and don't give me a raise. That's my example of that one. And taxpayers with an income above 1 million would pay the same taxes investment income as wages. Obviously, that's a lot to them, not to me. I'm not the millionaire a year person, but that's a lot of money down the road. It's just all part of the 2.0 tax breaks or plan. Now, people always say, what's the carried interest loophole, Dolph? I've had this question many times recently in a lot of appointments because they've heard it on media and stuff. Carried interest is a share of any profits that a general partners of a private equity and hedge fund receive as compensation, regardless of whether they contribute any initial funds. Biden's new 2.0 tax plan closes the carried interest loophole, meaning anyone claiming capital gains rates on high fixed rate participations in fund profits are not allowed to do that anymore. Just another compensation that some people were getting that they no longer get for the carried interest rates. This thing more was helping businesses than anything. That thing has been eliminated. These are some more of what he's doing with corporations, President Biden. Again, we talked about it. It's like the fourth or fifth time, but I mean, it's true. We're going to tack it on everywhere it is. Corporate tax hikes going from 21 to 28%. All corporates subject to 15% alternative minimum tax on book profits of 100 million or more. Amazon, sorry. Jobs overseas, exporting penalized. Investments on infrastructure, green energy, transportation, and manufacturing incentives. Global intangible low taxable income raised from 10.5 to 21%. And business offered new range of tax credits like incentive for small businesses to offer retirement savings plans. Now I'm going on here. I don't want people to say, oh, this is all gloom and doom. It's not gloom and doom. It's just reality. And that's what we're doing these presentations for. That's what Clear Income Strategies was built on. So building onto this is, how will this impact your savings? It's difficult to predict, and this is right from InvestBP there. It's difficult to predict or quantify what, if any, of these tax changes might have on a corporate stock valuation, and thus on the value of stock portfolios and retirement savings. Any effect on stock values probably would depend on the extent to which individual corporations have benefited from the provisions that the Biden plan would reduce or eliminate. What does that all mean? With respect to the proposed AMT on book income, the key factor would be the extent of which income is reported for financial purposes exceeds the income reported for corporate tax returns. Does that make any sense? This is directly a quote from him, Mr. President Biden, on how it's going to impact, these taxes are going to impact your savings. Folks, I'm going to give you I'll give you a keychain or whatever you want, but if you can email me back and give me your 2 cents on what you think that all means, hands off to you. Thank you very much for that. But let's go to the benefits for working families now. Let's get some positives in here. Yay. Bigger emphasis on tax credits instead of deductions. Child and dependent care tax credit expanded to $8,000 for qualified expenses for only low and middle income working families. It's a ceiling of $16,000 for multiple dependents. Child tax credits expanded to $3,000 per child from 6 to 17 years old, with an additional $600 per child under 6. This is great for those low and middle income family workers, that this is extra deductions you get to use and credits you get to use on your taxes to give more money to your kids, to get them back into school, to get them to educate more. So this is a nice thing in that aspect of it, is we're getting those lower and middle income people more money in their pocket to share and to spend. In retirement tax benefits, one significant potential substitution of a tax credit for present law deductions applies to retirement savings. The Biden plan would include rules, details unspecified, to equalize the tax benefits for contributions to 401k and other retirement plans across the income scale. Depending on the design of the new provision, the impact on high income taxpayers is going to be substantial. For example, if the proposed revision of the 401k contribution benefit, we've heard a lot about this in the papers lately, entitles a taxpayer with a marginal tax rate of 35% to a 20% tax credit instead of the current loss tax deduction, the tax savings for the current minimal annual contribution of almost $20,000 would decline by almost $3,800. That's huge. And that's not even talking about the 401k IRA proposed tax that's they're going through right now to try to impose, where they're going to propose anywhere from 1/10 to 1/4% tax rate on anything that's involved in the stock market or IRAs. Health insurance costs would offer refundable tax credits for healthcare insurance premiums. Wonderful. Goal is to limit family spend to no more than 8.5% of income. Well, right now, the average family is spending right around 14 to 16%, believe it or not, in healthcare costs by a national average, or more. So that's like half. So that's gonna be tough to do. Hope we can get it done. Increases tax benefits for purchasing long-term care insurance. This one we can't go on because no details have been released yet. Again, this is something that's going through the House with Mrs. Pelosi and Schumer and seeing how it makes its way through there. These are just 2.0 tax plans going for. Other aspects they're looking at this proposed tax plan is first-time homebuyer credits, student debt relief, which we've all heard about, payroll tax. He added a Social Security payroll tax of 6.2% on each employer employee for income, again, over $400,000. It's Mr. Johnson. I'm going to give you a job for $405,000 a year. No, Mr. Janice, just pay me $390 and don't give me a raise. It's going to save 6.2% on $400,000. He's going to save $24,000 a year by not making that extra $5,000 in income. What do you want to make this year? Estate tax exemptions. Reduce estate tax exemptions by approximately 50% from its current level of $11.5 million in estate taxes. Increases top rate for estate tax to 45%. So, Mr. Mickelson, you live in California, you just won the PGA championship. Oh, you collected $2.2 million, but you're only going to get 1.1. A lot of money, but sorry, we're taking the rest of it. Tax experts generally believe that the most wealthy individuals already take advantage of sophisticated tax planning strategies that reduce their tax liabilities and will continue to do so. These are people who are ahead of the game. Therefore, a lower exemption level may result in expanding tax planning, but only for a moderate increase in revenue. That's the importance of the Tax Max software that we run complimentary for you. I said 10 to 15 minutes. It can go over all this tax structure that you're in. This is federal only. We don't do state. Because state's a different animal. Federal, that how much money can you take in that will raise or lower your tax bracket. I've worked with Lewis and Judy, great people, great clients who did theirs a couple of years ago, and they were actually allowed to could take out an extra $14,000 to $15,000, and it didn't affect their tax rate at all. It was like free money. It was like an extra $1,100 a month, and it was wonderful seeing them be able to do that because now they can spend some more time with their grandkids and so forth. Now he's going to repeal the step-up basis and the basis rule. He's going to increase tax basis for inherited assets to their full market value upon death. Significantly greater overall tax burdens with respect to transferring of assets. This is a transfer of wealth step-up basis. We have handouts on this. I'm not going to, for legality purposes, I can't really go into too much detail on this because personal opinion, but it's just, this could be a huge tax liability for people that are getting wealth, and there's a way to transfer your wealth to different individuals that won't be nailed with this step-up rule, because the repeal of the step basis could be very costly to heirs who appreciated property values at all incomes level, not just the wealthiest. This could affect anybody from $20,000 to $20 million. It's something we have information we can share with you. I see a couple people already asked for it, so we'll get that. I'll get that to you right over. Lauren or I will get that to you right after the presentation or within the next 4 to 6 hours for you. And these are some future changes that have been also talked to about President Biden be doing. Although they're not included in the official tax plan announced during the campaign, additional changes reportedly are under consideration, including repeal of the cap on state and local tax deductions, repeal the like-of-kind benefit for real estate, incentive for U.S. job creations, and a phase-out deduction for pass-through entities such as S corps, partnerships, and trusts for individuals, again, with over $400,000 or more of income. Also changes, he wants to eliminate many of the Trump rules are going to be trying to be reversed. Many prior rates and benefits are going to be restored. So you got to plan accordingly. I mean, that this is happening, folks. You got to, whether we like it or not, some of these changes could be good. Some of these changes could be not be. It's your opinion. It's not left. It's not right. It's how it affects you and how are you going to plan accordingly. I've mentioned this throughout the presentation. Complementary tax map report. This is based on your personal situation. I'll provide you the information and how other different things can help you pay less in taxes. And this is just like a little small screenshot of part of that report comes out here. It's harmless. We can do it for every year going up till 2025 when the officially end of the 2020 tax cuts ends. But it shows you how much you can take out. It shows you about your Medicare premium, your base case, your Social Security, your ordinary income, your capital taxes. So you can call or text us at 704-307-0202 and schedule your 15, 20-minute consultation to receive this complimentary tax fact report for yourself. Folks, I truly appreciate you spending the last half hour with me, and I hope some of this information came across nice. I mean, I'm not one way or the other. I'm not going to say this is the way I think, kind of like Carter with liver pills. I'm not going to go into what I like, what I don't like personally. All I know is that when we did the Trump tax plan cuts of 2016 webinar, we just presented what he was going to do, and about 85% of what he said he was going to do did become in fruition. So with Biden's 2.0, we can expect 85% of this if history follows itself. We're going back to Obama, going back to Bush, and so forth. They're all their tax ones. The historical average is 85 to 90% of what they want to get done with taxes is going to get done. So we got to prepare accordingly. I have a Calendly link right there. You can click on Calendly. Whatever my calendar is wide open for you to pick the time, whether it's a 30-minute Zoom call, a 15-minute phone consultation, or come out to our new beautiful office here in Ballantyne. We'd love to do that for you. Again, I'm an educator. I encourage you to go to guardyoursavings.com. Those are all the complimentary resources, and we're adding them daily or monthly. We have new white papers coming out all the time on all different topics. More than happy to share it you at no cost whatsoever. Again, from the bottom of my heart, thank you very much. I appreciate you taking this time, and I hope to talk to each and every one of you soon. Take care and God bless.